Well, in the midst of IPO mania, it is hard to tell just how much these big IPOs are really worth. So we thought we'd bring in the Dean of Valuation, Aswath Damodaran. He is a finance professor at NYU Stern School of Business. Professor, welcome back. It's good to see you in person.
Good to have you on campus, too.
Glad to be back.
So let's start off with Lyft, since we're seeing Lyft trade below its IPO price, and there's a lot of hand-wringing, especially going into the Uber IPO. What is Lyft valued at? What should it be valued at?
My estimate, and I'm bending every single rule to breaking point, is I get to about 15 or 16 billion. I mean, you got a business that lost $1 billion last year, hasn't figured out how to make money yet. I mean, the business model is broken right now across the board on ride sharing. So getting to 15 billion was a stretch for me. Getting to 25 billion is way beyond stretching, at least as I see the company.
Okay, so this is $59 a share, which is considerably lower. Should we extrapolate, when you do these valuations, should we extrapolate to Uber? Because a lot of people are thinking, oh, well, should I apply the same sort of multiple to Uber? But it's a different business.
Well, it's a pricing game. Unfortunately, in a pricing game, you get tarred with whoever you're lumped up with. And Uber's watching Lyft like, I mean, this is what's going to drive whether Uber goes public at 80, 100, or 125 billion. So I think Uber's watching this pricing because no matter what their difference is, investors are going to price Uber based on what Lyft is priced.
Is there a typical either a premium or discount to your valuations versus what a share will price at? In other words, is there an embedded bias to the upside in terms of valuations when a company goes public?
I think the younger and less established a company is, the more the premiums tend to be because people build whatever stories they want into the companies. They have a selection bias.
These are not new kids on the block, though. Lyft,
are we talking about Lyft or Levi Strauss?
Oh, no, Lyft
is new in a sense. As a business, it's new. We really don't understand how the ride-sharing business is going to evolve.
Okay.
I mean, this is not the old car service business.
So it's not just the number of years it's been in business or whatnot?
No, I think it's still very young as a business. And as I said, none of these companies have figured out how to make money on this business yet.
Right. Levi Strauss, what is that worth?
I have it at about $28 per share. I mean, I really like the company. I know it's just an apparel company, but I still love my 501s. I mean, there's something about this brand name. I'll make a bet that Levi Strauss is still going to be around when Lululemon and Under Armour are forgotten. It's a brand name that's been around 150 years. It's got that going for it. And I think it has potential, especially in Asia, where they haven't grown as much yet. And if they can leverage their brand name, I think they can get the growth and maintain their margins.
Professor, you're talking about the profitability of these unicorns. And we've seen unicorns come through that haven't made money for a long time. And we talk on this desk all the time. I mean, Netflix, to me, still doesn't make money. Yeah. So how do you reconcile this? Obviously, Netflix is a very successful, proven company.
Right. I think there are unicorns where there's light at the end of the tunnel and unicorns where there isn't. I think Netflix, there is light at the end of the tunnel. If they can figure out a way to bring their content cost under control, their subscriber base is large enough and growing fast enough that the economies of scale are going to kick in. When I say that Lyft is not making money, it's not just that they're not making money, but there is no pathway right now, given how they're operating, to actually make money. The economies of scale are not kicking in because what allowed them to grow so fast is actually getting in the way of them making money. They scaled up fast because they had no capital investment, and they got in with, I mean, everybody's a free agent in this business. The drivers are free agents, the customers are free agents. There's absolutely no stickiness in the business, and they know it. I mean, they're throwing everything at the wall and hoping something sticks. But that's the basic problem I have with all the ride-sharing companies, and not just with Lyft. With all these companies, they haven't figured out how to make this work.
Even Guy Adami didn't keep his job there.
No. So let me ask you, for your 59, how did you get there? Did you have somewhere in your DCF model they break even?
In a sense, there's almost this mystic belief that somewhere along the way, because what they've succeeded at is changing the way we use car service. I have Uber and Lyft on my phone, and I never take a cab. So in that part of the game, they've succeeded. What they haven't figured out is how to make me stay with them, right? Because I'm completely disloyal here. I try both, and whichever's cheaper, I switch. And if there was a third service, I'll go to the third service. There's nothing in this model that keeps me stuck with a particular user. And the same thing with drivers. They can't keep them as Lyft drivers because Uber gets them away. This model needs some stickiness, something to keep customers and drivers attached to a service. Somewhere along the way, the business model has to be worked out, because otherwise we're going to end up with car service with companies which can't make money. So that's why I said the 15 billion is a stretch, because if they don't figure that out, we're going to be in big trouble.
Professor, so obviously your model is quantitative based, but from a qualitative standpoint, if you compare Lyft to, let's say, Uber, who just paid $3 billion for a company that does rideshare in the Middle East, where it's going to have very different economics, right? Probably worse margins than we have here. They've got Uber Eats, they got all this other stuff. Are they throwing tons of stuff against a ton of different walls rather than just one where it is Lyft? And is there more risk to Uber than
in fact, if you asked me to pick between the companies, I'd take Lyft over Uber because Uber wants to be all things to all people. And you'd think they'd learn from their mistakes. They went into China, backed out of China. They went to Southeast Asia, backed out of Southeast Asia. I think it's only a matter of time before they back out of India because they're losing enough money there that they need to get out to start to save themselves cash. So I think being less ambitious in this business until you figure out a business model that works is better. And Lyft, from that perspective, has been less ambitious. It's US-based, it's car service. Once you figure that out, then you can try to do other stuff.
Last quick question. We didn't ask about Pinterest. Have you done a valuation on Pinterest? I mean, it's on the road now.
A very preliminary valuation. And I'd say the same thing about Pinterest that I said about Snap. Keep it small. Don't go after the big market because Facebook, you don't want to go up against Facebook and Google head to head. You want to create a niche and you want to be in that niche, which means you got to be less ambitious rather than more ambitious. But I think that the mistake that Snap made, which Pinterest should not, is they thought they could be the next Facebook. They thought they could be bigger than they really could be. And I think I think what the signals you're getting from Pinterest is it's less ambitious. It's not trying to be all things to all people.
Okay. Professor, thank you.
Thank you.
Professor Aswath Damodaran of NYU. What do you think? I mean, the advice to Pinterest is interesting, especially when you think about Instagram's buy buttons and the ability to also monetize that in the
They
same
have the
way.
same risk, just like Instagram came right at Snap, right around their IPO. But I'll tell you that I think the last point he made is really interesting. This round of IPOs, these unicorns, they don't have the cult of the founder really overriding these things. The Lyft guys were really understated. Ben Silverman at Pinterest, are kind of understated. You're not making this huge bet. There was an Evan Spiegel premium in Snap when that came out a couple years ago. You don't have that in these names right now.